Welcome to JMCV Learning. Today it's grade 11 Business Studies and Accounting session number 2. In our previous session we discussed about few adjustments with our financial statements. Today I'm hoping to continue that discussion. So in the previous lesson we discussed mainly three adjustments with our financial statements. Income, that means income receivable, accrued expenses and bad debts. So today we are discussing depreciation, the fourth and the last adjustment in our textbook. So before we are talking about depreciation, let's see. I think you have in your house kitchen appliances with electricity usage like that, or electric equipment. With the time being, you don't use that equipment for your entire life. With the time, they are getting decayed and obsolete, so you throw them away and you purchase new ones. So why are you purchasing new equipments? Why do you have to purchase new things? Because the old ones are wearing off or decaying. So this is the base of depreciation. As a business, we purchase different types of assets, machines, buildings, vehicles, so on. So with the time spending, these assets are depreciated, that means decaying, and the value of these assets or the productivity of these assets are getting decreased. So this small detail, that means the value of assets getting decreased due to wearing off and using continuously. This matter we have to record in our financial statements. To record this matter, we have introduced this depreciation concept. So here I have written down the reasons for depreciation. These are some common reasons for depreciation. Number one, obsolescence. That means obsolescence means wearing off. By the time being, the value is decreasing, the productivity is decreasing, and deterioration, wear and tear, erosion. Erosion means if you take an asset like land, if it is located in some higher place or near a moisture place, that will get eroded. And decay, especially machinery, get decayed with their usage. All these words have the same, almost same meaning. Not the exact same meaning, but almost similar meanings, because all these words means that the asset reduces the production and the value of that asset is reducing due to these reasons. So now I'm coming directly to the definition of depreciation. Systematic allocation of depreciable value over the asset's useful lifetime. Some new words are in this definition. Systematic allocation, that means you are allocating systematically, proportionately. That's depreciable value. Depreciable value means how much you can depreciate in an asset. Depreciable value means how much you can depreciate of an asset. That means when you reduce the residual amount or residual value from cost minus residual value, you get the answer of depreciable value. That means cost is the amount we purchased, paying how much we paid in order to purchase this certain type of asset. And this residual value means how much we can obtain at the end of its usage period. Let's say we have a motor vehicle. Now it's 15 years old. It's really old. It's 15 years old. But still, other than throwing it away, we can sell it for iron or any parts like that for some sort of money, some amount of money. We can get some amount of money by selling that asset. That amount of money is called as residual value. The last value we can get after its usage. This value also known as different terms like scrap value also. So depreciable value means from the cost you remove the ultimate, the final amount of money you can get from its lifetime. So depreciable value, this amount is divided among its useful lifetime. That means how many years can we use this asset? At this useful lifetime, the value or the recording value of this asset will be 0. Clearly, the asset will be useless at the end of this useful lifetime. Useful lifetime can be measured by years. We can say this machine can be used for 15 years. That is the useful lifetime. How many years we can use it? Or otherwise, we can say unit basis. If you are producing something using that machine, we can say you can produce 10,000 units using this machine. After that, it's useless. Either we can say on the basis of years, you can use 15 years. Or we can say you can produce this much of units, the number of units basis. So, just keep in mind, it's a systematic allocation. We allocate it proportionally, nicely, with a basis, and over its useful lifetime, we are dividing how much it gets wearing off over its lifetime. And here, when calculating depreciation, we have two methods. One is straight line method. In this method, we assume a fixed proportion of depreciation is charged for each year. That means if we have 100,000 worth asset, a machine will say, and the estimated useful lifetime is 10 years. This machine can be used up to 10 years. So in straight line method, we assume this 100,000 is similarly divided into this 10 years. Therefore, 10,000 amounts will be depreciated annually. In the first year, it depreciated by, or its value is reduced by 10,000. In the second year, another 10,000. In the third year, another 10,000. Like this, 10,000 per each year. At the end of 10 years, the value will be 0. It can be a percentage also. We'll say this is depreciated by 10%. 10%. So, in the first year, depreciated by 10%, the same answer, 10,000. In the second year also, out of this 100,000, 10% will be depreciated. Another 10,000. It is the same thing. The same proportion will be reduced from this original value until its useful lifetime is ended. The second method we have is reducing balance method. Reducing balance method. In this method, we think that a proportion from the last value, that means a proportion from the net value, will be calculated as depreciation. It's like this. Now it is also same. 100,000 will say depreciated by 10% each year. This machine depreciates by 10% each year. In the first year, it's correct, it is depreciated by 10,000. But in the second year, we take the net value. Now, in the second year, from this 100,000, 10,000 already depreciated. That means the net value is 90,000. 10,000 has already gone off. So from this 90,000 only, we are calculating another 10% for next year. That means for next year, we treat depreciation as 9,000. In the third year, we reduce 9,000 out of this. Then you get 81,000. For the third year, you get depreciation 10% out of 81,000, 8,100. Like a compound basis. So, for our syllabus, grade 10 syllabus, we only have this straight line method. That means a fixed proportionate will be charged as depreciation. Now, we'll go to the calculations. Annual depreciation. Depreciation amount of an asset for a certain year. Annual means for certain year. To calculate that, we will need cost, residual value and estimated useful lifetime. We have to estimate this useful lifetime because nobody can say exactly this machine will be able to use this amount of time. Therefore, we will have to estimate a certain number of years. So, cost, out of cost, you have to remove or reduce the residual value. And the answer, which is, we recognized this earlier as depreciable value, cost minus residual value, we recognized as depreciable value divided by estimated useful lifetime. Or we can use another method, depreciable value, or you can use cost if they haven't given this residual value. You can use cost multiplied by depreciation rate. The rate I have given in this previous example like 10%, 20% like that. You have to multiply that rate from this depreciable value. Now let's see this using an example. Here I have given you cost 500,000, residual value 50,000, useful life 9 years. We'll assume this is a machinery, a machine. So first we have to calculate annual depreciation. Let's see how it's done. Annual depreciation we can calculate cost minus residual value divided by estimated useful lifetime. So here we have cost 500,000 minus residual value 50,000 divided by estimated lifetime 9 years. So 500,000 minus 50,000 means 450,000. So 450,000 we have to divide it by 9. The answer will be 50,000. That means this particular asset will be depreciated by 50,000 each year. Each year this asset will be depreciated by 50,000. Then there is another example to use the depreciation rate. We will see that also. Annual depreciation we can calculate. You have given cost and depreciation rate. So you can use cost into depreciation rate. Cost is 100,000. Depreciation rate 10%. That means 10,000 per year. The value of this particular asset will be reduced by 10,000 each year. Let's see how to put these transactions into ledger accounts. We need two accounts for this basic entering of this transaction. Those are depreciation account and provision for depreciation account. Provision for depreciation account. How to record this? This depreciation account is an expense account. Expense account, therefore, the entry will be passed into the debit side as provision. Provision account 10,000. This is a provision account, not yet provided. Therefore, the other entry will be accounted in the credit side as depreciation expense account. Depreciation expense account 10,000. Double entry will be completed like this. But when you are entering this depreciation to our financial statements, the profit or loss, that means statement of profit or loss. I'm writing it in short form because of the space. So statement of profit or loss, under expenses you have to record this depreciation amount. Depreciation under expenses, depreciation 10,000. But in here, when you are recording this under expenses, you have to consider the type of the asset. If the asset is relevant to sales and distribution, like a production machine and a distribution van, like that, if it is relevant to distribution expenses, you will have to enter this particular depreciation amount under this distribution expenses. But if the asset is used for the business purpose like office equipment, furniture, land, building, these things, you have to enter it under administration. And another thing, there's An asset in our daily, that means exercises, we often find that asset is not depreciating, it is appreciating. Now, we just discussed that almost all the assets are reducing their value over the time. But this particular asset does not depreciate at all the times. Rarely it is depreciating, but most probably, most commonly, this asset is appreciating its value. Day by day, its value is appreciating, not depreciating. That asset is land. And land, therefore, you can't provide depreciation. Because of that reason. Because the value of land, you can't estimate, this value will be reduced. Land, in common, the value is appreciated. And how to record this in statement of financial position? Statement of financial position. When you are recording this asset, you have to enter the name of the asset under non-current assets because we are using it more than 12 months. That is why we are providing depreciation over the time. Therefore, cost will be recorded as it is. 100,000 as this example. Accumulated depreciation. This accumulated depreciation means the total of depreciation you have provided up to this date. If you have purchased this asset earlier 3 years ago, you have to add and collect depreciation for these 3 years and write it here. But in this example, we have only 1 year. Therefore, we are writing 10,000, the amount we calculated as depreciation. The net value means the remaining value of the asset. What is the value of the asset for today? So, we had an asset of 100,000, but for this date, for the date we prepare this financial position, it has been depreciated by 10,000. Therefore, net value means the remaining amount 100,000 minus 10,000, 90,000. We only have 90,000 worth of value, worth of asset for today because 10,000 has already decayed, worn off or obsolete. So, this is the way of recording the basic depreciation entries. So, next we will discuss how to record all our adjustment entries. That means accrued expenses, income receivable, bad debts and depreciation. All these 4 adjustment entries in these financial statements. For that purpose, I am taking a past paper, a very easy past paper, 2016 O-level. If you have the paper, please refer it with me, or else you will be able to see it from our study materials. Let's take our past paper. You have to pay your attention on the additional information as well. They have given a trial balance, a list of balances, as well as some additional information. So let's go through this sum. Trial balance of Ravi's trading business as at 31st December 2015 is as follows. There you have given ledger account balances of Ravi's business and additional information. That is the very crucial part in this sum, because in this additional information sometimes you might miss some line items. Therefore, we have to read this additional information and we have to do workings to calculate the things mentioned in this additional information. So let's read. Cost of stock as at 31st December 2015 is 30,000. 31st December stock. This means the closing stock. When you read this particular line item, note down it your accounts. So in here I have drawn my profit or loss statement and financial position. Here I have to say some important things for you. When you're preparing these statements, you have to mention definitely, it is compulsory to mention the business name, account name and the time period you are preparing this particular account. There I have written down Ravi's business statement of profit or loss for the year ended 31st of December 2015. Now my stakeholders know which business, which statement for which time period. And in here I have written this rupees because I have to show in what currency I am preparing this statement. Therefore, those are compulsory things you have to show, you have to write when you are preparing financial statements, the name of the business you are preparing and the statement, the financial statement and the time period you are preparing. And additionally, the currency you're using to depict these figures. So our first entry will be the closing stock 30,000. So you have to record this closing stock 30,000 then and there. First we have to record in here when calculating cost of sales 30,000 within brackets because we are reducing that, and under current assets we have to record as inventory 30,000. Under current assets as well as under cost of sales closing stock. Now the first additional information is complete. Now you relieve. Next additional information. Machinery should be depreciated annually at 10% on straight line method. Machinery should be depreciated by 10%. This is a working. You have to show whenever you are calculating depreciation, bad debts and interest or something, if it involves a calculation, you have to show how you obtained your answer. Therefore, this depreciation adjustment you have to show under workings. My advice is when you're preparing these statements in your ordinary level exam, use separate sheets for each statement. This profit or loss statement in one page, this financial position in another page and workings in another page. Please don't try to not insert all these accounts or statements in one page. You have to have space for these transactions and you have to prepare it very neatly and cleanly. Therefore, use pages separately for these things and use a separate page for workings. Don't do workings under these statements. Some students, they prepare this profit or loss statement and they write the workings under this statement. Better than that, you can do is take a separate page and insert the transactions or adjustments as workings. It is clear. So, the additional information says machinery should be depreciated annually by 10%. So, we have to find the cost. Yes, they have given the cost as 150,000. So, workings or workings number 1, depreciation. Cost into depreciation rate 150,000 into 10% 15,000. Now we calculated the annual depreciation of that particular machinery. Now we have to record it. Here I am assuming this machinery is used for production purpose. Therefore, I am recording this amount of depreciation under distribution expenses. Under distribution expenses, I am recording this as machinery or machine depreciation 15,000. Like this. Machine depreciation 15,000. And I have to enter it into this place also. For that, I have to find whether there are any accumulated depreciations. So let's check it. They have cost of the machine, but they don't have previous provisions for depreciation. So we can record this immediately, and you can see above machinery you can see land and building at cost. That is also a non-current asset. Therefore, we can write both of these entries at once. Land and building under non-current asset. Land and building 400,000. No accumulated depreciation. Net value also 400,000. Machine cost 150,000. Accumulated depreciation 15,000. Now you have to deduct 15 from this 150,000. The answer is 135,000, like that. Next, we are moving on. 3,000 of debtors should be written off as bad debts. 3,000 of debtors should be written off as bad debts. Now you know what to do. You have to immediately record it as a distribution expense. Bad debts 3,000. Bad debts 3,000. And you have to show that you have deducted from the debtor value. Therefore, working number 2, writing off bad debt. Debtors we have 30,000. We have to reduce bad debts of 3,000. The remainder is 27,000 of debtors. That amount of debtors you can record here as debtors 27,000. Complete it then and there, then it will be very easy for you. Now we have already recorded additional information, and moving on to the trial balance. Capital 500,000. Capital 500,000. When you record a particular transaction or line item in the trial balance, please mark it, put a tick or a cross and mark it, then you will know you already recorded it. Then you will avoid misstatements, that means recording twice, or omissions, forgetting to record. Those two errors will not be happen if you mark the line item you are recording. Then stock as at 1st of January 2015, 10,000. That means our opening stock 10,000 here. Then purchases 280,000. Purchases 280,000. Now you can obtain the cost of sales here, 10,000 plus 280,000, 290,000 minus 30,000, 260,000. And next, sales 350,000. Sales 350,000. Next, debtors we have already recorded. Creditors 13,000. Current liabilities, creditors 13,000. Done. Next, 15% bank loan. 15% bank loan, 50,000. Non-current liabilities, bank loan, 50,000. Here, if you stop recording this particular line item from here, you are wrong. You have given a percentage in front of this bank loan. 15%. You have given a 15% in front of this 50,000. That means there is an interest hidden behind this line item. So, you have to make sure whether we have paid or not. We have to make sure what is the amount of bank loan interest. Make sure if you have given a percentage like this, you have to calculate that particular interest or depreciation, ignoring the fact they have given it as a line item. Therefore, we are calculating bank loan interest. $50,000 into 15%. 50,000 into 15%. The answer will be 7,500. The answer is 7,500. Therefore, you can record this directly to our finance expenses as bank loan interest, because this 7,500 we have to pay during the year. 7,500 under finance expenses, bank loan interest. Bank loan interest 7,500. Then we have recorded land and building, machinery, and next you have given bank loan interest. There you have 3,000. That means we have paid 3,000. But what is our actual expense? 7,500. Therefore, we have to pay 4,500 more. That means an accrued expense. Bank loan interest is an accrued expense for us because we haven't paid 4,500 of the interest at the end of the year. Therefore, we are recording accrued interest. Accrued interest 4,500 because the expense is 7,500 but we have paid only 3,000. The accrued amount we have recorded. Now, next, administration salary 14,000. Administration salary. They have clearly mentioned administration expenses. Therefore, administrative salary. 14,000. Next, discounts allowed 3,200. Discounts allowed is an expense for the business. 3,200 therefore goes under distribution expenses. Discounts allowed. $3,200. Next, discounts received 5,000. Discount received we consider as an other income. Therefore, under other income, discounts received 5,000. Next, rate. Rate means the amount we pay for the councils for our geographical location. That means if we are living in an urban area, we will have to pay rates for living in that particular area. Rates 8,000. Rates we can consider as an administrative expense. Therefore, rates 8,000. Next, advertising 12,500. Advertising definitely goes under distribution. Advertising 12,500. The last line item, cash in hand 7,300. Current asset, cash in hand the amount is 7,300. After recording all these line items only, you have to think about balancing these accounts. Now let's see how will these accounts be balanced. Let's look at the final balances of our financial statements. So, here we have cost of sales total 260,000 deducted by sales 350,000. Then we get a gross profit of 90,000. And for 90,000 we have to add other income. We only have discount received as our other income. When we add 5,000 of discount received to this 90,000, we get 95,000 total of other income and gross profit. The total of distribution expenses is 33,700. Then the total of administration expenses 22,000. Financial expenses, we only have bank loan interest which is 7,500. All of these expenses must be reduced or deducted from this 95,000. Therefore, we are getting a net profit of 31,800. This net profit we have to transfer to equity, which is I have recorded in here capital balance. Then after that you have to record the net profit of the year 31,800. 800. Then asset section, you have to total each of these columns. You have to take the total of the cost column, accumulated depreciation, as well as the net value. The cost column, there is a total of 550,000. Accumulated depreciation, we only have the machinery depreciation, which is 15,000. Then the net value of total assets, that means the net value of non-current assets, we have 535,000. Then current assets, we have only three types of current assets: inventory, debtors and cash in hand. The total of current assets is 64,300. Altogether, non-current assets and current assets, we get the total assets as 599,300. Then equity, we have capital balance at the beginning of the year and our net profit. The net profit and the capital balance all together we have 531,800. Then non-current liabilities, we only have the bank loan of 50,000. We can directly record it in this column, or we can pass from this column to this column. Never mind. Current liabilities, we have creditors and accrued interest. This addition of these two is 17,500. At the end, we get the total equity and liabilities, which is 599,300, will be equal to our total assets 599,300. By these values, by equaling these values, you can understand, or you can come to a conclusion that your double entry passing and mathematical calculations are correct. Your mathematical calculations and your adjustments are correct, but not everything. Therefore, I have told you few instructions or tips when you are preparing this certain sum in your O-level exam. This will be your last question in your question paper. So, I have to tell these special points regarding this lesson. You have to write the business name, the statement name, what is the statement you are preparing, and the time period. For what time period you are preparing this, and the currency you are using to depict these figures. And you have to show each titles separately. One competency of this lesson is to identify these expenses for separate segments. That means you have to identify distribution expenses under distribution, administration expenses under administration. That classification also a competency level in this lesson. Therefore, finally you have to show net profit very clearly with correct figures, and you have to put brackets for the things you deduct. Then you won't be mistaken, otherwise you will add all these together. That is a common mistake. Therefore, to make sure that you won't add, to notify you, put these brackets for these figures you are hoping to deduct. Everywhere, closing stock, cost of sales, like that. And when it is coming to this financial position, you have to total these balances accurately, and definitely you have to transfer this net profit under capital. Then bank loans and the things you forget to record is some things like this accrued interest and this deduction of bad debt. That is why I told you to take it as a working. Therefore, that will remind you that you have to record this value in your financial position. Always make it clear how you get these figures. How you get these figures, like depreciation, you have to show calculations all the time. Then you won't be mistaken. And another thing is, If you have given a percentage value like 15% bank loan, you have to calculate the bank loan interest no matter whether they have given the interest or not. If there is a percentage, make sure you calculate that amount. That is it for today's lesson. We discussed about depreciation and how to account for these financial statements with our adjustments. Here in this particular sum we had about 2 adjustments we practiced. Therefore, in next session we'll do a revision exercise as well as continuing these lessons from your textbook. Therefore, we'll meet in another lesson. Thank you.